Okay, let's start. I added some clarifications for the assignment. Just because I got a lot of questions about the preferred dividends in the first question, because that $6 and $8 are preferred dividend per share, and some kind of just out of, I guess, a habit interpreted as a par value or issue price, so the number don't add up. So I add some clarification there, so hopefully that's not going to be a problem going forward. Also, just about the final exam on the on the banners. We have not decided on a time yet, but we could use that time, but our exam will not be in-person exam, will be online through Brightspace. So ignore that. Okay, today about the income taxes. Okay. So we did a quick review about the assets liability approach. So today we'll start on chapter 18 proper. So these are the topics we're going to talk about. As I mentioned early on, textbook is rich with the details, way too many details. Some people may say that. So I try to streamline it, focus on the important parts. And so this is the list of topics I will cover. So first we talk about the two incomes, accounting income versus taxable income, and what they mean, what they're for, and what are the connections. And the second, we talk about the two types of differences between accounting income and taxable income, permanent and the temporary differences. And then the third part would be the accounting for income tax, given there are differences. Okay, and two additional topics. One is about income loss carry forward, which would require to use the accounting method we talked about, but it's a very specific application. And then intra-period tax allocation, that's the last topic. Okay. Most of us are taking income taxes concurrently, right? No? Okay, so I will stick with the accounting part. If it comes to beyond where the accounting is involved, probably you are a better expert than me. But anyway, I will stick to accounting for income tax. Okay, so two incomes, accounting income and taxable income. So accounting income, we have been spending 3.5 course. Basically, the important part of financial reporting is the income statement. So this accounting income, we should know it as income before taxes. Okay, so that's what it is. In the income statement, there's a point after revenue, expense, and the gains and the losses, you come to income before taxes. That's it. It's called the accounting income because it's determined in accordance with the accounting rules, either IFRS or the ASPE. Okay, so because it follows the accounting rules, the objective is for financial reporting. It's a part of the reporting to capture the financial performance, right? So it's subject to accrual-based accounting and all the revenue recognition and the measurement rules. Okay, taxable income is a tax accounting term. So this is the number that would be in the tax returns. Okay, it would be tax returns. So it's a taxable earnings subtract deductible expenses gives you this taxable income. Okay, so it's determined in accordance with the Income Tax Act and regulations. And it is used to determine income tax payable. So this is very important concept in this part of the discussion, income tax payable. That is the amount you actually have to pay, right? You file tax return, and that's the amount that of the tax due for this period. And if you if you file personal income tax, you'll be familiar with this, right? So that's like usually there were deductions and so on and so forth. So that amount, if you never have a payroll deduction, that's the amount you actually have to pay. Okay, write a check or e-transfer the payment. If you have already deducted some from your, your employer has deducted some, so there will be the difference between this amount and what's deducted. If you deducted more than this amount, you get a refund, otherwise you have to pay. So this is income tax payable is the amount, it's a cash. It's, from accounting perspective, it actually requires payment. Okay, so this amount would be in your statement of cash flow, indirectly or directly, this amount will be deducted. Okay. The difference between accounting income and taxable income, obviously are the differences between the GAAP, being it IFRS or SB, and the tax rules. Okay, so the process for our purpose is to determine taxable income, because we do need to know that. We start with the accounting income. Also, this should be accounting income, sorry. Start with the accounting income. This should be accounting income. And we adjust for the differences, and then we get taxable income. That will be the process we follow in this course. Okay. The differences between accounting income and the taxable income can be permanent or can be temporary. Okay. So the implications of these two types of differences are different. So we will focus more on the temporary difference, because permanent difference are easy. You just, you said this one is not taxable, remove it. This one is not deductible, remove it. That's it, right? Oh, the additional one needs to be taxed, put it in. That's it. So a permanent difference means the items recognized for accounting purposes, but not for income tax purposes. That's one. The second one would be item recognized for tax purpose, but not for financial reporting purpose. Essentially, permanent differences means that the accounting rules and the tax rules disagree on the treatment of the items. Should it be included or not? One says it should, one says it does not have to be included. That's the difference, right? So, for instance, fines a company pays for violation of any rules, laws, and their expense for accounting purpose. Their mistakes, right? It costs company money, so their expense, but they're not tax deductible. So essentially, it makes sense. The government is not going to help you if you did not follow the rules, right? So there's no break there. Golf dues, hospitality related expense. I think the rules, some of them are not deductible at all, because that's basically like it's a personal benefit for the executives, whoever. Some are deductible at the 50%. So like if the CEO takes a client to dinner, so I think the argument is, well, it's business related because, you're talking to clients, but you did eat food and drink the wine. you know, so half. Okay, there's personal enjoyment part that's not deductible. That's constant. Dividends from taxable Canadian corporations. So when one Canadian company invests in the equity securities of another tax-paying Canadian company, when the investee company pays dividend, it's not taxable because that's after tax income already, right? So like the government is not going to collect tax twice on that income because it's income, corporate income tax on that amount has already been collected. So that's the difference. Item recognized for tax purpose, but not for financial accounting purpose. Example of that are fewer. So this is the one, depletion allowance for natural resources in excess of cost. Okay, so this related to resource company, like, you know, like they have depletion as expense, but sounds like you can deduct more. Okay, so as I said, the permanent differences are easy. You just, you know, you prepare the accounting income, follow the accounting rules, and then any differences, you just adjust that. If this one is not taxable, remove it. You know, that's it. And so reversing or temporary difference is called the reversing difference. These are the items that the accounting rules and tax rules do not disagree whether it should be included or not. However, they disagree one, it should be included. Okay, so the items are treated the same for books and the tax, however, in different periods. Okay, so therefore, that's why it's called the reversing. So, so when it's included in one, not included in the other yet, there's a difference. But eventually it will be included in the other one as well. So it's reverse. There will be no difference after that, right? So there is a originating timing difference. That's when one included, the other has not yet. And there's a reversing time difference. That's like, you know, the other one included it, but the first one is already included in here, right? So in the originating time differences, that's a period in one of the statement, it has it, the other one doesn't. And then in a reversing difference in the statement, the other one has it, the first one doesn't, because it's already reported. So in the example, so let's say the example of, in the example of installment sales, which we talked about, right? So when the sales were made or are made, let's say, it's included in financial statement, right? So it is included, so they are included in like say income statement, but not in the tax returns. Okay, so therefore in this year, like the taxable income will be less than accounting income. And because taxable income is less, so there means certain tax is postponed. And it creates you have a deferred tax liability because certain income is not due for tax yet. Okay, so you kind of like in this case are not included in, so taxable income, okay, but not tax, but not in not tax return. Okay, so the taxable income will be less than accounting income. So that, I don't know if you can see that, that give rise to a deferred tax liability. Right? We'll talk more about this just in a minute, but it doesn't make sense intuitively. Because taxable income is less than accounting income, that means you pay less tax. And it's not you are exempted from that, it's just you postpone it, right? So when the installments are received, they are included in the tax returns because like it could be in different periods, but you don't have to include it in income statement anymore because you already did that, right? So therefore, the taxable income would be more than accounting income. So what happened is now you will be paying for that deferred tax. So deferred tax liability will decrease. Eventually, the deferred tax liability will be zero when all the installment payments are received. And that's the difference. The temporary difference is completely reversed. So that's how it goes, right? So, so far we're just talking about how things work. We have two sets of rules. We need to prepare for financial statements for financial reporting purposes. We need to prepare tax returns for tax purpose. And this difference between the rules will cause these kind of differences. Now we move to the accounting part of that. We move to accounting part of that. Now, how do we report that? The first one is called the tax payable method. This one is the simplified method. So it's allowed under ASPE, but not under IFRS. Okay, so you prepare your income statement, come to income before tax, you stop. And then you go to do your tax return. And on the tax return, whatever, tax payable is, you have to send the check. That will be your income tax expense. That's it. Okay. So current income tax. So this will be the number in the income statement. It will be the same as the number in the tax return. Simple, right? You just need to do for tax return, then you will have the answer to that. But this one is a simplified method. It's allowed only under ASPE, not allowed under the IFRS. Under IFRS is this, our new friend, we use asset and liability approach. We use asset and liability approach. Okay, so we start with the current income taxes. That's the same tax payable from tax returns. And then, as we discussed in the previous slides, that temporary reversing differences give rise to deferred tax liability, and sometimes can be asset as well. Okay. So using the asset liability approach, the changes in the assets or liabilities give rise to income or expense. Okay. So start with the current income tax, adjust for changes in future deferred tax assets liability, and that change will be recognized as future or deferred income tax expense. So therefore, under this approach, okay, so income tax has two parts. So that's why it's called income taxes. Okay, you have current income tax, which is your tax payable, but you also have a deferred, or I will just follow the term, deferred future or deferred income tax. Two parts. Okay, the first part is from the tax return. The second part is the change in deferred tax assets or deferred tax liability. Okay, so that's the situation. Okay, and this is what we must do under the IFRS. Okay, I think a couple more slides, we will do an example. So that we talked a lot about, but a couple more slides. Now, this part, I kind of simplified significantly from the textbook. Okay, the textbook talk about the accounting base and the tax base and so on and so forth. And the accounting base is easy. The accounting base is just the carrying amount. It's basically whatever, you know, it's on the balance sheet. But the tax base, the definition is quite what would you say, not neat. Like a tax base, if it's asset, it's one definition. It's a liability, is another definition. But in fact, you know, you probably will talk about this in your tax course, so I will leave it to the tax. For accounting purpose, you can skip those two, get to the third step, because the carrying amount accounting base allow you to determine what kind of temporary difference it is. So the temporary difference can be taxable temporary difference, and that definition for that is more intuitive. Okay, so taxable temporary difference means that the difference will be added to accounting income to determine taxable income in the future. That's it. So taxable temporary differences, because this difference will be taxable in the future. That's it. Okay, so sometime in the future, when this difference reverses, you need to add this difference to determine taxable income. So in the future, the taxable income will be more than accounting income. And that kind of is very intuitive, because if future taxable income is more than accounting income, that means I will need to pay more tax in the future. I will need to pay more tax in the future. That's deferred tax liability. Okay, and there is the other way around called the deductible temporary difference. So that means the difference will be deducted for tax purpose in the future. Okay, and so that means in the future, the taxable income will be less. The future taxable income will be less, and the future tax to be paid will be less. Okay, why? Because you did not deduct it now. So that means if future taxable income will be less, means right now the taxable income is more, right? So, so this gives rise to a deferred tax asset. It's very similar to prepaid tax, kind of thing. Prepaid expenses in an asset, right? Like a prepaid rent, prepaid insurance premium, they are carried on the balance sheet as an asset. So this deferred tax assets is similar to prepaid income tax. Okay, and when the future comes, when you reverse that, your tax payable will be less, and then you will be using these assets, just like when you use the rented facilities and you already paid rent, you can recognize rent expense, but there's no payment anymore. Okay, so let's look at, before we look at the example, a terminology, right? So the asset and the liability approach is required under IFRS, and it's option for the small and medium, like a private entity, right? I think that's true for almost everything. If company that's subject to ASPEs always have the option to go more extensive reporting if they want, and just follow the IFRS. You have that choice. However, public company cannot choose. So because of that, because this asset and liability approach can be applied in under both IFRS and ASPE, so there's a bit of terminology difference. So the same method, the asset liability method used under ASPE is called the future income tax method. And this one gives rise to assets liability, and they will be called the future income tax assets, future income tax liability. And in the income statement, it will be called the future income tax expense, future income tax benefit. The same asset and liability approach when used under IFRS, you just substitute all this, the future with the deferred. That's pretty much it is. It's called the temporary difference approach or deferred income tax approach. So instead of future tax assets, future tax liability, future tax expense, we call it the deferred tax assets, deferred tax liability, deferred tax expense. Okay, so from now on, we just, instead of repeated, we just use deferred. Okay, so before that, I kind of sometimes use the both. Okay, so if we are ready, we will look at the example. Okay, so this is an example. So there's information here. So what it tells us is this company so this is the company has accounting income of 70,000 each year for all 3 years, 2017, 2018, 2019. So that's given. Okay, you have done your income statement up to the income before tax. You got 70,000 each year, but for 2017, among these $70,000 accounting income, there is a $30,000 sales on credit. So when you talk about temporary differences, right, for our purpose, essentially there are two types of differences that cover most of the examples. One would be related to depreciations and amortizations. For accounting purposes, we can depreciate, amortize, whichever way we want, as long as we can justify that that's a faithful representation of what's going on, right? However, for tax purpose, the companies do not have choices. So all the long-term assets are in one of the 6 classes. Maybe I got the number wrong. And then there is a capital cost allowance rate set by Canadian Revenue Services, Canada Revenue Services for each class. So that's how much you can deduct. So basically, accounting depreciation you can choose. Tax depreciation, you have to follow the capital cost allowance schedule for that class of asset. And then the accounting depreciation and tax depreciation can be different. So that's a major source of temporary difference. The rest, basically you can kind of have a big picture is accounting, financial accounting income is based on accrued rules. Taxable income is more or less based on the tax rules. Okay, so with that in mind, you can pretty much kind of understand the temporary difference very well. So here, the $30,000 of the 2017's accounting income are from credit sales. So that means that $30,000 net, right? You did not get a cash yet, and therefore it's not taxable yet. And they will be taxable when payments are received. So 20,000 of which is collected in 2018, and 10,000 is collected in 2019. Okay, so this is a temporary difference. The sales should be reported for accounting purposes. The sales should be taxable for tax purpose. However, for accounting purposes, 30,000 should be reported in 2017. For tax purpose, this amount will be reported, included in 2 years, 2018 and 2019, based on the amount collected. Okay, so because of that, the taxable income would be different from accounting income, right? Well, in 2017, we need to remove that from accounting income to derive at taxable income. For 2018, in addition to the accounting income earned during that year, there is also an extra collection of 20,000, and that should be included in accounting income to determine taxable income. And 2019, the remaining 10,000 should be included in to calculate taxable income. So what kind of difference is this? Is it a taxable difference, or is this a deductible difference? It is temporary difference, yeah, but which type of temporary difference? Taxable, because the difference is added in the future, right? To determine accounting income. So the differences means it's taxable in the future. So that's taxable difference. And remember, so that little bit, you like the 2 slides back, that's the slide when they talk about the differences. That's a slide probably you need to kind of spend a little time, let it sink in. Because once you get that in, this will be easy, right? So taxable difference give rise to deferred tax liability. Okay, taxable difference give rise to deferred tax liability. Okay, so so we got the first part of the income tax here, right? With the taxable income calculated, adjust for there, we assume there's no permanent difference. We just for temporary difference. Then we got a taxable income, and this will be our tax payable, and this will be the current portion of our income taxes, right? So we got the first part, right? And then we need to go get the second part, the deferred part, right? So we do it 1 year at a time. So first, let's look at the deferred tax at the end of 2017. We do it 1 year time. So what do you do? This is what you do. At the end of 2017, because we're talking about the taxable difference in the future, right? So the future years we need to investigate would be this 2 years, because the temporary differences will be reversed in that 2 years. So that's the 2 year we are going to look at, right? So in 2018, the future taxable amount, this is part of the taxable differences will be reversed. So when this amount is added to future taxable income, that will result a tax liability of 5,000. Yes. And then the remaining 10,000 will be added in 2019. So when that is added, it will result another 2,500 tax liability. So these are the future tax to be paid. And by the end of 2019, that this temporary difference would be fully reversed. No more differences, right? So therefore, standing at the end of 2019, we say, oh, there is 7,500 tax which we defer now to the future, to be paid in the future. And that is our deferred tax liability. So we want to see that on the balance sheet. Okay. Now, assuming there's no differences before, we start with a clean slate, assume that. So our adjustment would involve to increase deferred tax liability from 0 to 7,500. Okay, so that means a credit to deferred tax. DT here means deferred tax. Credit deferred tax liability 7,500, and we will debit deferred tax asset expense 7,500. So this is the asset and the liability approach at work, right? So asset liability approach means changes in the assets and the liability is your revenue or expense or gains and loss. And here, as a result of this temporary difference, we have a deferred tax liability of 7,500. And to adjust that, to adjust your balance sheet, to adjust to that desired balance of 7,500, we also recognize deferred tax expense of 7,500. Does it make sense? Any questions? Okay, couple of things. Well, we're going to repeat this, so we'll have another chance to go over that. A couple of things. You notice that the taxable difference at the end of 2017 is 30,000. However, deferred tax liability is not 30,000, right? That difference gives rise to deferred tax liability by applying tax rate to that difference. So that's one thing to keep in mind. The second is that not deferred tax expense is the changes in deferred tax liability. Okay, even though in this year the number is the same, but conceptually they're not same. Okay, deferred tax expense, it is not the deferred tax liability, rather it's the change of deferred tax liability. Okay, with that in mind, we can go on for the next year. Okay, stop me if you have a question anytime. So the next year, this is 2018 now. We're standing at the end of 2018. And so this temporary difference is partially reversed, but not completely reversed yet. So the remaining difference will be reversed in 2019. because we were told that the last 10,000 will be collected in 2019, right? So when that amount, that taxable difference, when that amount is collected, it will be added to deferred taxable income, right? It'll be added to taxable income, and there will be 2,500 tax. And that's it. No more, right? So therefore, as of December 31st, 2018, the deferred tax liability should be 2,500. Okay? Yes. And so deferred tax liability is 2,100, 500 in the statement of financial position. But there is a balance in that account as a result of the adjustment we made in 2017, right? The balance before we make any adjustment is 7,500. So in order to get a balance of 2,500, we need to debit this account. We need to decrease deferred tax liability from 7,500 to 2,500. And if you debit this account, the change is decrease in liability, that will result a credit in the income statement account. So then if it's a credit, you can't call it a deferred tax expense anymore. It's the opposite. So we call it a deferred tax benefit. Okay, so we'll call it deferred tax benefit. Okay. So, so maybe I will do I didn't do a journal entry. Maybe I will do a journal entry. So I will do a journal entry for this year. So the journal entry, they're not necessarily big, aren't they? Okay, so the journal entry required to record the change is this. We will debit deferred tax liability by 5,000. And we will credit deferred tax benefit. That'll be 5,000. And this is the adjusting entry will implement the asset and liability approach into this, like the deferred tax. Okay, so let's go back to do the journal entry for the year 2017 as well. Okay, so year 2017. Okay. Will debit deferred tax expense, right? Because we need to credit deferred tax liability, so we need to debit deferred tax expense. Credit deferred tax liability. 7,500. So that, okay. Now, so that's here. Now, a common mistake for year 2018, a common mistake for 2018 is, oh, you want deferred tax liability to be 2,500. I credit deferred tax liability 2,500. That would be wrong, right? So that's a rookie mistake because we mistaken the changes with the balance. Okay, you want the balance to be 2,500, you have to see what the balance it is there. Okay, so that's a common mistake. So then let's go to the next year. Yeah, that there is next year. So now we're at the end of 2019. Okay, there's no more future change anymore, but doesn't mean our work is done. Okay, because we still carried that deferred tax liability, right? So at the 2019, now all 3,000 has been included in both financial reporting in the income statement that's done in 2017, and also in the tax reporting, because that all 30,000 is included in tax returns, 20,000 2018, 10,000 2019. So there will be no more difference. So future taxable amount is 0. Okay, and therefore there should be no deferred tax liability. Now, so see here because it's a future taxable amount, and so we know this is deferred income tax liability. So that's why that slide that discussed two type of differences are important, because we know there's a difference, but then we need to know exactly what kind of difference it is. So if we know it's a deferred tax, it's a future taxable difference, then we know on the balance sheet there should be deferred tax liability. That's why that slide is really important, right? So now we know it should be 0. Okay, so deferred tax liability is 0, should be 0 in this statement of financial position. So to achieve that, it's not do nothing. To achieve that, we have to remove the 2,500 that is in there. Okay, so we need to decrease in deferred tax liability, the decrease in deferred tax liability from 2,500 to 0 will lead to 2,500 deferred tax benefit in the income statement of 2019. Okay, so let's do the journal entry for that. Let's do the journal entry. Okay. The journal entry. I'm just going. Will debit deferred tax liability by 2,500, and we will credit deferred tax what? Benefit. Exactly, benefit. Okay. And so when after we did all that calculation, so this we can prepare our income statement properly with the proper income tax in accordance with the requirement of the first, right? So 2017, we have accounting income of 70,000, and we have current tax, if it's expense, so the negative number means the expense. So that's, see, the current tax expense in bracket means if you see a negative number, it's expense. It's 10,000. We calculated that. We calculated the 4 slides back, right? When we calculate taxable income, adjust for that difference. So it's 10,000. And the deferred tax expense is 7,500. So the total tax is 17,500. 17,500. And so the net income is 52,500. That's 2017. So this row, the current income tax is computed when we computed taxable income. And this row, the deferred tax, we calculated in each of the 3 slides when we analyze the difference, right? So so that's for the second year, the taxable income, I think it's 90,000. And so the current income tax expense is 22,500. And then we have a 5,000 deferred tax benefit. So the tax is 17,500. Again, the third year, the current portion, the tax you have to pay is 20,000. And then there is a 2,500 deferred tax benefit. So your tax expense is 17,500. Again, okay. Okay, so your net income is this. So kind of like, what the heck? We did all that, seems no difference. If I apply 25% on 70,000, I will get this number. It is true. It is true. Unless if the tax rate is not the same every year, or if tax rate changes, then you will not get the same number. Okay, so you apply, if this is accounting income, even not all of that has to be paid to this year, but I know all of them eventually needs to be paid. Why don't I just apply the tax rate to this number? Lots of cases, you will get the same results. However, the fundamental approach different. If you apply the tax rate to accounting income, that will be the revenue expense approach. Okay, and that lots of times the situation is such that you will get the same results, but does not mean there will never going to be a problem. There will be a problem if the tax rate for each year is different, and there will be a problem if there is tax rate change. Remember in our previous class when we talk about the difference between asset and liability approach, right? If such situation exists and you use revenue expense approach, you will have deferred tax liability. It will just stay on your balance sheet forever. Okay, your liability will not truly reflect what you owe, what your obligation is. Okay, so it's not like I like to give you guys busy work to go through all that to get here, right? It is important, and to the fundamental approach, the principle, the philosophy behind it is different, and sometimes you will get the different answers as well. Using the revenue expense approach, you will not get the correct answer. Okay, so given in this example that every year the tax rate is the same and there is no change in tax rate, so we have the same results. So basically we can see in 2017 we have accounting income and there's no permanent differences. All the differences are temporary. So that means the tax on this income is partially paid this year, and this 70,500 will be deferred to be paid in the future. In 2018, so now you're not only paying current year's income tax, you're also paying 5,000 previous year's income tax. And 2019, that again, you are paying current year's income tax, but the amount you paid, the actual amount you paid is the current tax. That includes 2,500 that earned in 2017. in 2017, right? So you defer to paid now, but you recognize the expense owed in 2017. So that's why these are, so all of these you're paying before. And so what these will be the reversal of the deferred tax expense. So it will be deferred tax benefit. Okay. Okay, so now let's look at what happens to our balance sheet, on the balance sheet. So I would just, okay, the income tax in the balance sheet. Okay, so that's, it works? Oh, it works. Okay, so I'll just use this. Okay, so this will be our balance sheet account. This will be deferred income tax liability. Okay, so there's a zero start out, deferred income tax, there's zero to start out. So that's this way. So this is balance on, say, January 1st, 2017. Okay, so as part of the end adjustment of 2017, we need to recognize that 7,500. So $7,500 is added. So this is adjustment of 2017. Adjustment of 2017. So with that, this 7,500 would be the deferred tax liability in 2017 balance sheet statement of financial position, right? So that's what. And in 2018, we need to make adjustment. The adjustment is debit deferred tax liability. So this will be 5,000. So this is a adjustment of 2018. Okay, so with that adjustment, the balance will become 2,500. And so this is the deferred tax liability in 2018's financial statement, statement of financial position, or the balance sheet, the same thing. Then adjustment of 2019 is a further debit of 2,500. So with that, the balance becomes 0. Okay, so that's a deferred tax liability in 2019's statement of financial position. Okay. Actually, what goes into income statement is based on this, right? Remember, we analyzed this first in order to determine, because asset liability approach is in that sequence. You start with measuring the assets and liability. That's a starting point. based on the information that's proper, and the proper measurement of liabilities here will give rise to deferred tax asset, deferred tax liability. Okay, so so this is just one of the example. This is just one of the examples. So company usually have multiple items that may have temporary differences. And so what we need to do is we need to kind of have similar adjustment for each one of them. And then your deferred tax will be the sum, or sometimes some items give you deferred tax expense. Some items give you deferred tax benefit. So it will be the total of all of that together. Okay, so we have time left. So instead of starting something brand new, let's go over an example, another very, very common example. It's about the depreciation. So I would just, I didn't bring it up, so that I will just do it here. I will just do it here. Example, it's a PPE. And quite often, the PPEs, I'll use this one, sorry. I just don't want. Okay. So very common situation is the company would use straight line method for financial reporting purpose, which is the straight line is I think used most of the times just because it's simple. That's one. For financial reporting purpose, you're allowed to choose. So why don't you choose a simple one? And also it has the benefit to give you a higher net income, right? If you go like, because straight line depreciate less than the salary depreciation method. And it's all the better, you do not have to use the straight line for tax purpose. So because higher income means higher tax, but happily you can switch for tax purpose. So you get best of the both worlds. You report higher income, yet you don't pay more tax. That's great. So that's a very common situation. So let's say ABC purchased equipment for 100,000 with zero residual value, and let's say 5-year useful life. Okay, let's say that. And so ABC use the straight line method for accounting purpose, but double declining balance method for tax purpose. Just that's something like that. Just assume that is, but is required. But is required to use a double declining balance for tax purpose. Okay, so what would happen is the depreciation will be different each year, okay, for accounting purpose and for tax purpose. So move it here. So for year 1, 2, 3, 4, let's get all 5 years. 5 years. So depreciation would it be 20,000 each year? Okay, and I will skip a line. Just right here. And what do we call this? Capital cost allowance. So that's the amount you can deduct for tax purpose. For year one will be 40,000. Double. And for year two will be 24,000. For year three will be 14,400. And year three would be it doesn't look right. Yeah, I know what. Would it be 8,640? And the last year, we will kind of we will have to use the plug-in. We forgot. Never mind about the 12,960. Oh, is that added up? 12,960. Yes, 12,960. So that's our, okay. So kind of a touch to the concept that, as I said, it's not necessary, but in the textbook, lots of examples use the carrying amount and the tax base. And so we will use the example to kind of add that into our discussion. And you can see, well, they're good, but we don't absolutely need it. And sometimes they can be very complicated. So the carrying amount basically is basically the book value. And the carrying amount is essentially the amount that to be deducted in the future, right? We know expense is essentially the expired assets. When the asset expires, the cost of the asset become your expense, right? So what's not deducted yet, carried on the book, will become deductible as an expense for financial reporting purpose in the future. So that's carrying amount. And the second year will be 60,000, and third year will be 40,000, and the fourth year will be 20,000. It will be 0. So that's the carrying amount. Tax base, same idea. The reason it's called a tax base is this amount will work into tax returns in the future. It provides a base to calculate the income tax in the future. That's called the tax base. So there will be, in this example, that's why I choose this example to illustrate that. In this example, tax base is quite intuitive. If you imagine you have a balance sheet for accounting purpose, and imagine you have a balance sheet for tax purpose. So it'll be the book value on your tax balance sheet. But if we're talking about the liabilities, you know, the example is not intuitive at all. What is the liability on your balance sheet? That's fine, but what's the tax base on the liability? They just tell you to calculate this way, but they did not explain like it very well. So instead of, you know, it will make our life a lot easy just if you can imagine worked out what is the future deductible amount or what is the future taxable amount. That'll be a lot easier. So the tax base after first year, after you deducted $40,000, there's $60,000. Actually, there's a term for that. It's this tax base. It's UCC, right? In your tax course, it says this is CCA, this is UCC. And depreciated capital cost. Okay, and after the second year, deduct additional 24, that's 36,000. Okay, and you deduct additional 14,400 is 21,600, and after that would it be 12,960, and then after that would be 0. Okay. So keep that in mind. So let's continue with the example of the PPE. So that will probably just do 1 year. So at the end of the year 1, at the end of the year 1, we have 4 years in the future, right? So copy this, and no, I do not want to copy this. I want to copy this. I'll just copy this. That doesn't allow me to copy. Okay, so we have year 2, year 3, year 4, and year 5. Those are the future years we need to look at. Okay. Year 5 and the total. Okay, so using this, we will look at this difference of each year. The difference that will be reversed each year will be different from year to year. And when you do this year by year, it also allows you to deal with the situation if the tax rate are different from these years, right? If the tax rate for these years are different, then you can compute. So for 2000, for the year 2, the amount to be deducted for depreciation is 20,000. The amount to be deducted from tax purpose 24,000. So there will be a future deduct or taxable amount. So in the year 2 is 4,000. Okay, and year 3, I'll just read off the amount, is 5,600, and year 4 would be 11,000. Oh, sorry, 11,000. 11,360, and year 4 would it be 8,640. 8,600. No, not sorry. I'm sorry. 7,040. 7,040. And so these are future taxable amount, because the difference is different, because the first year is original differences originated, and the second year the difference is increased. Still we deduct more for tax purpose than accounting purpose. It's start third year, the reversal started, and the total of that should be 20,000. Okay, total of that should be 20,000. Okay, and you apply the tax rate to that, and so this will be let's say 20% for each year. Let's say 20% for each year, but we have room to accommodate for any difference in tax rate that's applicable to all the future years, right? So we have deferred tax asset or liability. Make sure we keep in mind that these are have different signs. So it's if it's increase the temporary difference or decrease temporary difference, we'll make sure we use different signs. So that will be 800, and this year will be 1,000. This deferred tax liability 1,120, and third year would it be 2,272, and the third year will be 1,408. So altogether, we should have a deferred tax liability of 4,000. So don't forget, this is a future deductible amount. Now, obviously, it is possible you would just, because the tax rate is the same, you could use, say, the total future deductible amount is, future taxable amount is 20,000, and at the 20% tax rate, we have deferred tax liability 4,000. That would be okay that if the tax rate is same every year. Okay, so I went over a lot. 5 minutes, not too bad. Okay, so the Thanksgiving does not affect us, but a happy Thanksgiving anyways. Okay.
Thank you.